Good morning, everybody. Thank you so much for joining us. This is already episode 15 of the Meet Me for Coffee podcast. Really excited today to be talking economics again. We took a little bit of a break, but we're back. So, my guest today is going to be Mazen Danaf. He is the senior staff applied scientist and economist at Uber Freight. I'm going to go ahead and bring him in because my first question for him this morning is what exactly is a staff applied scientist and economist at a company like Uber Freight? Good morning, Mazen. How are you?
Good morning, Samantha. I'm good. How are you?
Good. Go ahead and introduce yourself and help us understand a little bit more about what your title is, what your role is, and maybe also a little bit of background into your career and how you got here.
All right. Yeah. So I'll start with the background then. As you said, I'm a staff applied scientist and an economist at Uber Freight. I've been with Uber since I finished my PhD in 2019. I joined Uber ATG as a data scientist at that time. So Uber ATG was the branch of Uber that does autonomous vehicles, and that got divested and sold to Aurora. And then I moved to the freight industry with Uber Freight, where I've been here for like 2 years now as an economist and an applied scientist. An applied scientist is similar to a data scientist, except that we do more like complex modeling of the data. And that, in my case, that involves a lot of economic modeling, looking at a lot of economic data, like supply and demand, and trying to get these relationships not only from the qualitative analysis, but also what the models are telling us.
So, real quick, what do you think? Like, what's one of your realizations that you've learned as you study like economic data sources as they relate to freight markets? Like, how closely correlated do you see those two things being?
Yeah, so the first realization I made coming from the passenger transportation world is that the freight world is much more interesting. That's because in the passenger world, you can just isolate a city. You're looking at a city, you can isolate the city, look at that city. You don't need to look at anything else. You can look at what's happening in that city, the supply and demand in that city. Let's say you're looking at like ride sharing or public transportation or like scooters or whatever. You don't need to look at the rest of the world. That's not the case in freight. You need to look at everything else. You need to understand what's going on in China and Russia and in the Middle East, everywhere around the world, and obviously what's going on in the US, in different economic sectors, in different industries. So you need to be aware of all of this.
Yeah, no, that's an awesome takeaway. I think that I kind of had my own realization of that to some extent when I started trying to understand more proactively, like freight market pricing. Because, I've been in sales and selling truckload services, and I was trying to understand why are rates the way they are. And then it was like this rabbit hole that I accidentally ended up going down because you realize you can't just go, well, rates are X because Y. It's so much more complex when you start looking into all of the economic data factors that are like driving the market cycles that we have. So cool. Thank you for introducing yourself. I also wanted to ask you a little bit about some of the work that you do. I think I've been following it for a while and we connected almost a year ago already, but I've been reading your monthly reports that you put out. And so I wanted to ask you to kind of talk a little bit about that because I think it's a good glimpse into a lot of the work that you do on a monthly basis, on a day-to-day basis that gets captured in that. So what's kind of the thought process behind the report? What is the report trying to encapsulate? And what is the type of work that goes into producing those monthly economic reports?
Yeah, definitely. So we put together these monthly reports, which are on the Uber Freight website. They call the Freight Economist reports. I lead the development of these reports, but with inputs from the entire Uber Freight leadership team, like a team of experts on different modes, on different areas. Each one provides input. They provide recommendations for carriers, for shippers. And the logic behind these reports is, I would say, two things. The first thing is that there's a lot of demand for this. So shippers are asking for that, carriers are asking for that, brokers, like everyone wants information. And the second reason is like we are in an industry that has a lot of data, but sometimes we don't have a lot of information. And the difference between the two is that data is equal to information plus noise. So a lot of people sometimes are focusing on the noise. So we're looking to for ways to like just give the information and not to focus too much on the noise. And if you look at, like, I'll give you an example of what some of the noise in the industry. We look at a lot of indicators, let's say, of freight demand. And these are very valuable indicators. Like every indicator is valuable by itself, but each indicator has some type of noise in it. So I'll give you a couple of examples. We look at the American ATA truck tonnage index. We look at the gas shipments index. We look at spot loads, and we look at tender volumes. And each one of these is a measure of some type of freight demand or like
Right.
freight volume. But each one of them has its own noise. Let's say like
Mhm.
the A is focused on contract freight. The CAS is more focused maybe on manufacturing freight. Uh, Tender volumes is like, is it really a measure of volumes, or is it just like the number of tenders? Is it like a weighted measure of supply and demand in some type? Because if you increase supply and keep demand the same, your tender volume will decrease. So it's like each one of these has a signal and a noise, like some information and some
Yeah,
noise.
I think that was a little confusing and overwhelming for me too when I first started to try to understand,
Yeah.
what resources I could go to, because I would kind of initially bank a conclusion on maybe one source because it seemed reliable. I mean, how could this data, be wrong? And it's not that anyone was necessarily wrong in the numbers it was reporting. It was just like nuance to however it was pulling that data, right? So it sounds like you guys are kind of trying to take all of those into account and account for the variables and the noise that are in all of those, and then try to make like a conclusion based on all the findings across those different sources.
Yes, yeah, exactly. So we're trying to look at a variety of sources, a variety of external sources, trying to like all of these data are like valuable by themselves, but
Right.
it's how we analyze them, right? Uh, so we're looking at all of these external data plus our own internal data, which includes more than like maybe like millions or tens of millions of shipments
Yeah.
every year on the Uber Freight platform. So last year, I think we had like probably $17 billion of freight under management. This year, it's something similar. So we have a lot of data, and we
Yeah.
can capture a lot of market trends in real time. So we make sure that we're analyzing both the external data, the economic indicators, as well as the internal data from the Uber Freight platform. And we put it all together in this Freight Economist report.
Yeah, and it's a good balance of things because it touches on kind of like, I like to say, I'm thankful for people like you guys who make economics like something that we can understand, like layman's terms, essentially. So you're able to take some of the most important economic data releases that come out every month and then correlate them to freight markets, but kind of write it up in a way that we can understand. And so that's been something that I've really enjoyed finding, different sources where people are able to make it a lot more relatable to us. Because if you were to just tell somebody in freight, oh, you need to understand economics to be able to, be the best you can be in this industry, that's a huge task to undertake. So thankfully, there's people who are already scientists and economists that can help us with that. Okay, next question, because you talk about the economic side of the report, but it also touches on rates, and you do a little section usually in the report about spot or contract rates, or maybe whatever's most timely to the market in that month. So can you kind of give us like a little sneak peek? I think your report is coming out this week, but can you kind of talk through what you're seeing on the rate side in either spot or contract or whatever it is that you're going to be focusing on with the most emphasis this month?
Yeah, definitely. So let's start with the recap of what happened. In the last like year and a half, we saw the largest decline in spot rates that we saw in history, especially like more than a year ago, January, February, and March. That was the period of time where rates declined from the record highs of like maybe $3 per mile, excluding fuel,
Right.
by 30 cents per mile per month. So for 3 months in a row, it was falling by 30 cents a mile. And now it's almost about like half where it was in its peak. So rates are
Yeah.
about cut by 50 or 55, 45% maybe from their peak. Uh, Spot rates have fallen in maybe 13 of the last 15 months. Maybe I might be wrong, but that's more or
Sounds
less.
about right. Yeah.
Yeah. Uh, and they have stabilized in the recent. We saw a slight increase in May, and we're seeing a slight increase in June.
Okay.
Does this mean that the decreases are behind us, like we're in the clear? Looking at like historical market cycles, they all bottomed in May.
Mm-hmm.
So it is consistent with, I think DAT has a chart about that. They've shown it in the past. Previous market cycles have bottomed in May.
Right.
Now, doesn't mean that this time it's the same, maybe, but maybe we're just seeing a seasonal bottom. And
Right.
because June is by definition a strong month in terms
Right.
of seasonality. So what we're
Yeah,
seeing,
I've heard some commentary around maybe like a soft build up to like that 4th of July weekend kind of that we were having. And then again, like a little bit of a slump and or even maybe just maintaining until peak end of summer type season comes back around. So
yeah,
yeah, okay.
yeah. So I would say that the increase we're seeing right now in terms of spot rates is it's what we expect in terms of seasonality, but it's even weaker than the traditional seasonality. We
Right.
should expect a higher increase in rate, like a bigger jump in rates, and we are not seeing that. So
Yeah.
if you look at economists look at the seasonally adjusted data, if you seasonally adjust the rates, they are still decreasing.
Right.
They haven't started increasing yet. But yeah, we're keeping an eye on things. We're keeping an eye on a lot of supply and demand indicators, which we'll go over in a few
I
minutes.
always ask anytime this is brought up, and I know we might have people listening who are trying to start understanding these things. When you say seasonally adjusted, what what would you say is the reason that we need to look at things on a seasonally adjusted basis, and kind of how are some of the ways that you choose to format your views like that? And I know that I think it's helpful to look at a couple different ones. When I do my monthly report, I usually do seasonally adjusted year over year, but then also just month to month, not year over year comparisons as well. So kind of talk about year over year comparisons and seasonally adjusted and what you mean by that.
Yeah, of course. So most of the seasonality comes occurs over the course of a year. So if you're plotting, let's say, any time series data, let's say retail sales or consumer spending or anything, and you plot it on a chart, you'll notice like it has these seasonal patterns. It goes up
Yeah.
and down in very, very regular patterns. And that's because of various things. So I can name a few. Maybe like each month has a different number of days. So that's the first reason. So
Yeah.
people spend naturally more in March than February, just because March has more days than February.
Yeah.
The second reason is seasonality in terms of, let's say, produce and freight. We all know that produce comes in specific months of the year,
Mhm.
and that drives a lot of freight demand in regular months. So every year is going to be the same. We had the peak season, the Christmas and New Year's. It always occurs at the same time. It drives like freight demand up as well. So all of these factors occur every year. They're very regular, and the seasonally adjusted data just takes these effects out
Right.
and normalizes the months to be compatible to each other.
Right. So
So
you
that
can truly tell what the gain was month to month or year over year without allowing, from one month that was a holiday month to the next to make it look like there was either a large decrease that was non-typical, essentially.
exactly. So it's comparing the month to month fluctuations compared to like what we should expect these fluctuations to be.
Right. Okay.
And the year over year automatically takes care of that, because with the year over year, we're comparing like June of this year to June of last year.
Yeah.
So it automatically, we don't need seasonal adjustment with that because it automatically happens.
Yes. Okay. So we talked about spot rates. Anything that we should be noting or taking a look at on the contracted side of rates right now?
Yeah. So contract rates usually lag spot rates. My best indicator of contract rates is to take a like moving average of spot rates over the last year and see how that's trending. So they lag by about 6 months or so, which is the middle of 12 months. And given what we saw in spot rates, we should expect contract rates to continue to decline maybe in the next couple of months
Yeah.
before they bottom out. If spot rates do bottom out, which I think should happen, because like both spot rates are definitely below the carrier's operating costs. I don't know if you saw the report from ETRI that came out two days ago. Spot rates, by our calculations, are way below the operating costs for both small fleets and for large fleets as well. So large fleets are losing money on almost every spot rate that they're moving right now. Contract rates are still above that operating cost per mile, but they're also approaching it given the rapid declines that we saw in the past few months.
So I think whenever we talk about carriers' operating costs and where the spot rates are falling, essentially and maybe not always, but most likely drives a change in the market cycle or kind of kicks us into the next phase in the market cycle is enough driver attrition in the market to create that supply and demand imbalance again, to start making the carriers kind of have a little bit of an advantage there when it comes to their capacity. So I think what I found really interesting so far is that it just seems like this has kind of been like this long time coming. And maybe it compares with other years. I'd love to know that, but just seems like we have attrited drivers slower this year than maybe in cycles past. So what do you think, like, where's our progress right now with driver attrition? Can we avoid driver attrition? Is it inevitable? And what are some of the drivers right now for this slower attrition that is happening?
Yeah, so I think it is, I wouldn't say it's inevitable, but it's a necessary part of the process for the market to correct itself.
Okay.
It is happening. We are seeing signs of attrition, but at a slower rate than what many would have expected, maybe like 6 months ago.
Okay.
So if you remember last year, if you listened to like carrier earnings and a lot of analysts, many of them were expecting a rebound in the freight market, maybe around like between Q1 and Q2. This obviously didn't happen in Q1. Q2 rates continued to decline. The market did not recover. And that's because this correction in supply is happening at a much slower rate than many have expected. So if you looked at the most recent earnings of carriers and the most recent analysis, they have pushed their forecasts of when the market is expected to recover, but into like early Q1 or late Q4 of this year.
Right.
So when you look at the supply side of the data, we're looking at three different data sources. The first one is the BLS, or the Bureau of Labor Statistics employment data.
Right.
One of my favorite data points is the data in the long distance truckload sector, which is dry van, long haul. I don't know if it includes reefer, it might, but it's mostly dry van, long haul. And that's the number of employees in that sector, the majority of which are drivers. When we look at that compared to the previous cycle, like if we compare it to the most recent cycle, which was 2019, it occurred at a much sharper rate because when COVID happened, we saw this sharp reduction in employment because of layoffs. So a lot of companies were seeing demand falling off a cliff, so they laid off thousands and thousands of drivers. And starting late 2021 to 2022, throughout 2022, we saw a huge increase in driver supply or driver employment, which far exceeded the pre-pandemic levels. I mean, maybe like 5% to 10%, which is huge in this terms. Right. It peaked around the beginning of this year and started falling slightly.
Okay.
April's data point was an increase again, but I think that's just a data thing. We should expect to see like a downward trend, but it's a very slow downward trend. It's nothing like supply is falling off a cliff. So that's the first data point we're looking at. The second data point is FMCSA data, the number of carriers. So you can think of the first one as like the number of drivers or employees. The second one is the number of carriers.
Okay.
This captures all carriers, including owner operators. So it's everyone with an operating authority. If you look at that chart, also we'll have a very interesting chart in the report showing how in the last 6 months the market lost about 15,000 carriers. So which were squeezed between high operating costs and low spot rates. But in the last 2 years before that, the market gained 125,000 carriers.
Right.
So the 15,000.
I was just going to say, like, 15,000 sounds like a huge number when you're just like thinking of it in terms of like, wow, 15,000 carriers, even if that was all owner operators, that's still, such a big number, but it's really nothing in comparison to the gain of the last couple years before that.
Exactly. It's like, it's just a drop in the bucket. Yeah. And the third data source we're looking at is equipment data from ACT Research. ACT Research have great insights into what's happening in the equipment world. And it seems like carriers are still adding equipment despite the softening market. They're still adding trucks. And I had a nice conversation with Tim Denier from ACT Research, and he was saying that, carriers are just hoarding trucks. They're preparing space to keep them idle, but they'd rather have the trucks than not, because they had a period of time where they couldn't get access to trucks. Right. There was a lot of pent-up demand, and they're expecting a similar period of time over the coming years where it might be hard for them to get trucks, so they might just order them anyway.
It's a minor, hopefully, inconvenience for a long-term gain, I think, is a thought process there. And that, while they might get the trucks and just have to park them right now because there's just not a need to justify using them, as soon as enough drivers attrit the market and they're able to take more of the market share, then they'd be able to have the advantage of them, utilizing more equipment, putting more drivers in those seats to try to capitalize essentially on the higher market when it comes. It's a smart business play, but I could see how it could be a little stressful on operating costs in the short term.
Yeah, it just delays recovery in the freight market because we still have this lingering.
Right. So it's almost ironic in a sense because they're doing that in preparation for a higher market, but at the same time, you delay the onset of that higher market coming by continuing to hold on to that equipment, and also not just the equipment, but the drivers, right? Because we're seeing this slower attrition. And I know, Shelley Simpson just spoke publicly on the Freightways podcast yesterday, I think it was, and she said that JB Hunt's committed to not laying off any of their drivers. So seeing all of the capacity, especially from a lot of these larger companies, remain in the market is just kind of another one of those signs of that slower attrition. So I guess it's just delaying the next phase of the cycle, right?
Yes, and it's understandable when you look at it from a lens of a carrier who had a really hard time in the previous 2 years hiring drivers.
Right.
It was almost impossible to get the drivers you want. So now, as you said, like there's a lot of maybe hoarding of labor and capital by carriers.
Yeah.
And what we're seeing, and we'll also cover this in the report, is that productivity is going down. So when we look at data from the Bureau of Labor Statistics about how much these drivers are working per week, their work week, it has fallen down sharply to like levels that we only seen maybe during recessions. In LTL, it's even worse than that. Like the LTL sector seems to be hit the hardest by this. And driver productivity has fallen to levels that are worse than the onset of the COVID pandemic.
Right.
So drivers are working less hours than they were in April 2020 or May 2020. They're idling for a lot of time.
Yeah, because and LTL is an entirely different beast, but I think you could put them right up there with like the JB Hunts of the world, right? These very large asset providers who have these large networks that require their skilled drivers to be able to operate, and they put so much money and resources into recruiting the drivers that they needed for peak season employment. And usually there is naturally in the LTL space that time where you maybe lay some people off, or you just take advantage of like some temp workers as needed to kind of sustain you through the lows. But I think right now there's full employment, and there's just that hesitation to change that even during the slower parts of the market cycle right now because of the, maybe call it like COVID PTSD that everybody had, where they were quite literally losing revenue because they were not able to have the manpower to operate the potential business.
Yeah,
so
exactly.
It's a difficult one, right? It's kind of like, and I think this is where it's going to come down to like who is in a position financially to be able to wait it out the longest, right? Like who can retain their employees and maintain profitable operations long enough to still outlast a slower change in the market cycle to get to that high point where you make it to the high point, you retained your employees, you have the equipment ready, and now you're able to have a great year or two, in that higher part of the market cycle.
So. Yeah, exactly. It's about like optimizing your costs, optimizing your operations as a carrier. I'll give this example again on the ATRI report on the cost per mile. So they estimated the cost per mile at $2.25, I think, per mile to operate a truck. Now that's considering all the miles traveled. If you want to calculate the cost per revenue mile, we need to normalize that by the deadhead, right? So if you have two carriers, one that are identical carriers in terms of their cost structure, but one of them is deadheading 10% and the other is deadheading 30%. For the carrier that's deadheading 10%, your cost per revenue mile, which is comparable to rates, should be around $2.65. That's based on last year's fuel, so it's a little bit higher. So it's $2.65. For the carrier that's deadheading 30% of the time, that cost is $3.15 or $3.14, which is 70 cents a mile higher than the carrier who's deadheading only 10%. it's about like 70 cents a mile, which is about 30% of the total cost per revenue mile. So it boils down to who's more efficient, who can control
Right.
their cost more, including this deadheading.
I used to be fairly naive in the process of like optimization for carriers. And now, with our unique business model here and all the work that we're doing with our carrier partners, I realize honestly how difficult it is when you think like carriers to just find consistent freight on these perfect little loops where you're never deadheading, you never have any down hours, everything's perfect, drop and hook, turn and go. And it just like never ends up working like that. So, even when we're talking about like, this is the bare minimum that, these carriers need to run profitable operations, there's always going to be continual fluctuations to their network and different, capacity changes and volume changes from their even direct shippers and things like that. So there's so many variables that go into it. And I've heard some people saying, right now, in regards to the driver attrition, especially like in the owner operator space, that a lot of carriers are just like one breakdown away from not being able to recover from that. Everybody's kind of operating on these razor thin margins of error right now, where one major mechanical failure that's going to cost you several thousand or more dollars is just it would continue to eliminate capacity, because there's just such little room to work with right now in the current freight market for a lot of carriers and owner operators.
Yeah, and that's what the data is showing. We're seeing like a record number of authority revocations, a record number of carriers exiting the market. So it's all mostly because of low spot rates, but also the high operating costs.
Okay, we have time for one more question, and I just want to double back because you touched on LTL. And so real quickly, I've seen some commentary in the recent months around, LTL being high or low is a reflection of the truckload market, or the full truckload market directly impacts the LTL market. Or now that fuel is going down, maybe we're seeing some mode shift considerations again between intermodal and full truckload. So just can you kind of briefly explain what you think happens and what you're seeing across, let's call it mode shifting between LTL, intermodal, and the full truckload space as rates vary or different factors come into play like fuel?
Yeah, definitely. So we have been seeing a lot of mode shifting. So the first thing we're seeing is that demand was starting to decrease. The overall pie started to decrease, but the distribution within that pie was favoring truckload to LTL and intermodal, which means that the year-over-year declines in truckload that we saw in total demand, we estimate them about like 4% or so. We have seen much higher decreases in LTL volumes year-over-year and in intermodal volumes. And they're for different reasons. So when you look first at the intermodal sector, we all know about the port strikes, about what happened there. We'll know about the nearshoring as well, which took a lot of import volume from across the Pacific into like the land, maybe like inland freight.
Yeah.
So these are like a couple of reasons for the weakness in the intermodal sector, and also a reduction in overall imports. We've seen imports plummeting by 20 to 30% in the year over year. On the LTL side, it's also a combination of two things. So if you plot the LTL year over year, I think ACT Research have a cool chart on that as well. It's very highly correlated with the ISM manufacturing index. So a lot of manufacturing activity is driving LTL freight. And we've seen some weakness in the manufacturing sector recently. So the ISM has been going down for like into contraction territory for like 7 months in a row now. It implies that the manufacturing sector is getting weaker month over month. And LTL is following that. But also the other factor, as you said, is the mode switching between truckload and less than truckload, which is also affecting intermodal as well. But the rate reductions that we have seen in the truckload sector are much, much sharper than the reductions that we have seen in the intermodal or the less than truckload sector. So there is a lot of mode switching as well. In addition,
I think there's more, obviously, like we just talked about, there's more immediate exposure in the full truckload space to market volatility because driver attrition is so much more real, I think, because so much of the capacity that's provided in the full truckload space, essentially being these independent or small fleets or owner operators, where they don't necessarily have the security of like a large LTL carrier or these intermodal providers, even who have been around for many, many years and have their time slots. There's been some unique instances of companies failing in like the intermodal space recently, and also LTL over the last year. But I think that LTL operates more on an annual pattern, obviously, with the GRIs and the annual tariffs and the negotiations and things of that nature, that they're maybe given a little bit more of a cushion, right, in retaining their revenue and their margins longer into the slower cycles. Than obviously the full truckload space, especially if you're operating in like a spot market space where it's just constantly changing on a weekly basis, essentially.
Yeah, it's the difference between a market where like the top 7 or 8 players have 70 or 80% of the market.
Exactly.
The other market on the other extreme where like it's so fragmented that you can't even come with such a number.
There you go. Just like we could have literally boiled down everything I said to that. You have like, 8 or 9 major players, and then you have hundreds and thousands of players in another. So definitely makes up some of the difference there. Well, we're actually a little over time, which I'm okay with because this was an awesome conversation. But Mazen, what's the best way that people could connect with you? Also, I would love for them to be able to access your report. So how do they sign up to make sure that they're getting the monthly report?
Yeah, so the monthly report is available on Uber Freight's website under the resources section. It's called the Freight Economist Report. I think there you can find my contact information. My email is the best way to reach out to me if you have any questions. And if you log in today, you'll see last month's report, but in a couple of days or in a few days, we'll update it to this month's version of the report covering the most recent data.
Perfect. So reports coming out this week. Hopefully by the end of the week, you'll be able to see that. And then if you don't already follow Mazen on LinkedIn, please do that too, because he always shares insights into the market throughout the month. And we appreciate the work that you do there, Mazen. Thank you for that too.
Thank you so much, Samantha.
Well, this was awesome. Thank you so much, everyone, for joining us for coffee today. And we hope you have a great Tuesday.
Bye.